All right, so check this out. CoreWeave just reported their latest quarter, and honestly, the numbers are kind of wild. I'm going to walk you through what's actually happening here because there's a lot more going on than just stock goes up or stock goes down. So first things first, CoreWeave is trading around $138 right now. The stock's been pretty volatile lately, bouncing between like $130 and $145. But here's the thing that caught my eye. This company is absolutely hemorrhaging money right now, and yet people are still betting big on it. Why? Let me explain. Look at their revenue. In 2022, they did about 15 million bucks. Not bad for a cloud computing company, right? Then in 2023, they jumped to 228 million. That's a massive leap. But then 2024 hits and they pull in almost $2 billion. Yeah, you heard that right. From 228 million to nearly 2 billion in 1 year. That's insane growth. But here's where it gets interesting. When you dig into the quarterly numbers, their most recent quarter shows revenue at 1.21 billion, but they're losing over $260 million every single quarter. They're burning through cash like crazy. Their operating income is negative. Their net income is negative. Basically, every line that should show profit shows red ink instead. So you might be thinking, wait, why would anyone invest in this? Good question. Here's the deal. CoreWeave is building the infrastructure for AI. And I mean serious infrastructure. They're not just running some servers in a closet somewhere. They're building entire data centers packed with expensive GPUs that companies like OpenAI and other AI labs need to train their models. Think of it like this. Remember when oil was first discovered? The companies that owned the oil wells lost money at first because they had to drill, build pipelines, hire workers, all that stuff. But once the infrastructure was in place, that's when the money printer turned on. CoreWeave is basically doing the same thing, except instead of drilling for oil, they're building the picks and shovels for the AI gold rush. Now, let's talk about where their money is actually coming from. Almost all of it, like basically 100%, comes from their cloud computing services, and most of that revenue comes from the United States. They made about $1.8 billion from U.S. customers in 2024, with the rest scattered across other countries. Here's something else that's pretty telling. They don't pay dividends. Zero. Zilch. Nothing. And they've never paid dividends before. That tells you they're in full growth mode. Every dollar they make is going right back into building more capacity. Let's look at their balance sheet for a second. Their gross profit margins are actually pretty decent, around 50% in recent quarters. That means for every dollar they bring in, about 50 cents is gross profit before operating expenses. But then they have massive operating expenses eating up all that profit and then some. We're talking over 400 million in operating expenses per quarter. The analysts watching this stock have it rated mostly as a buy. Out of 29 analysts, most are saying strong buy. The average price target is around $139, which is basically where it's trading now, but some analysts think it could hit $180. Others are more conservative and think it might drop to $32. That's a huge range, which tells you there's a lot of uncertainty here. Now, here's what I find really interesting about the technical setup. If you look at the charts, the stock has been in this pattern where it rallies hard, pulls back, then rallies again. The moving averages are showing a strong buy signal right now, which means the momentum is upward. But momentum can change fast, especially with stocks this volatile. Let's talk options for a second because this is where things get spicy. The options market is showing some pretty high implied volatility. We're talking 87% on the 30-day. That means people expect big moves in either direction. The put-call ratio is sitting around 0.65, which means there are more calls being bought than puts. That's generally a bullish sign because it means more people are betting the stock goes up. But here's the reality check. CoreWeave, like any other stock, still has risk. They're profitable on paper in terms of gross margins, but they're losing money overall because they're spending so much on growth, which to me personally is a good thing. The big question is whether they can flip that switch and start making actual profits before they run out of runway. Their debt situation is something to watch too. They've got a decent amount of debt on the books, which makes total sense because building data centers isn't cheap. The long-term debt-to-equity ratio is around 2.77, which means they're leveraged. Not crazy leverage, but definitely carrying some weight. So, what's the play here? Well, if you believe AI is going to keep growing like I do, then CoreWeave is basically selling the infrastructure that makes it all possible. They're the ones providing the compute power that trains ChatGPT, helps design new drugs, powers autonomous vehicles, all that stuff. But, and this is important, they're not profitable yet. They might not be profitable for a while, And there's always the risk that bigger players like Amazon, Microsoft, or Google decide to compete more aggressively in this space because, well, those companies have way deeper pockets. The bull case is pretty straightforward. AI demand goes through the roof, CoreWeave captures a big chunk of that market, and eventually their revenue growth outpaces their spending growth. When that happens, they start printing serious money. The bear case is that they burn through too much cash before getting to profitability, or competition squeezes their margins, or AI demand doesn't materialize the way everyone expects. One more thing to consider. Their revenue growth is slowing down on a percentage basis. Yeah, they're still growing in absolute dollars, but the year-over-year percentage gains are getting smaller. However, that's completely natural as companies get bigger, but it's something to keep an eye on because growth stocks live and die by their growth rates. If you're looking at CoreWeave as an investment, you're basically making a bet on the AI infrastructure build-out. You're betting that the companies building AI models will need so much compute power that CoreWeave services become essential. And you're betting they can manage their burn rate long enough to get to sustained profitability. Pretty wild ride, right? This is one of those situations where the fundamentals say this company loses money, but the narrative says this company is building the future. And in markets, sometimes the narrative wins, at least for a while. So there you go. That's CoreWeave in a nutshell. Anyways, I hope this video helped you on your quest for profits. I'll catch you on the next one.